Hello and everyone, welcome to my YouTube channel. My name is Mohak Pachisia. I'm the founder of Technically Sorted. So, if you go to my channel, you will get enough introduction about me. I'm not going to waste too much time on that. You could also go to www.technicallysorted.com. My basic motto over here in the capacity of a trading coach is to share some insights with you as to how we can trade better. And today I have decided to take up the topic of trading gaps. Now, one of the most interesting concepts I have come across in whatever research and studies and formal education I've done as a technical analyst, that these gaps which are there on the price chart have a very unique way of presenting themselves, have very unique properties, and sadly, a lot of people are not clear about how they can take advantage of knowing the nature of gaps. So in this video, we are going to go deep into understanding the very nature of how gaps behave. Okay. So point number one is that before we start, okay, one thing I want you to know that no matter how good you are, no matter what you're looking at and what are the variables we are looking at, etc. Okay, no matter what, we need to have certain principles in place before being able to take any trading decision, right? If we have those principles in place, then our trading decisions will be in accordance with those principles, and those principles should lead you to make a net profit over a series of trades. You should learn about probabilities, that whenever you're reading price charts, there is obviously a probabilistic expectation that your variables have come together and the move is ready, the move is right, okay, and you want to enter a trade. But there can always be a mistake, you can always go wrong, and that is a part and parcel for anyone, even the greatest traders in the world, okay, even greatest investors in the world. You can be wrong in the markets. So what I will tell you is that we are going to dissect this concept as to why something happens, and when you see a situation, gaps can be of multiple kinds. Gaps can happen because of different reasons, and gaps can happen anywhere on any chart on any single day. But if you have the understanding of what is the driving today's gap, you will not go and blankly trade one gap. Like if you trade a breakout gap, it will be way different than trading an exhaustion gap. Okay, so there the chances of you going wrong will come down, and you being right, the high probability trades will come in your choir. Okay, so let's start with dissecting why these gaps occur and what causes these gaps to happen. First of all, the reasons why gap can happen could be an overnight news. For example, there is a news which has a very strong implication on the market or on a particular stock. It may be so that in the previous day, say Reliance has got awesome results and the quarterly results have come after the market hours. Now, every value investor over there or every investor over there will say that, okay, looking at the results, looking at the massive growth in the quarterly profits, and this is just an example, this could be for any stock or any company, a massive growth in quarterly profits. Looking at this, the valuation of the stock should be so much, and the price is much lower in the market. So if the strong hands want to go and buy at a higher price the next day morning, the gap will occur because they are ready to pay a higher price. See, at any given point in time, a price only is a transaction between the best buyer and the best seller. So at 3:30, if a price closes at a certain level and there is a huge gap up the next day, it simply means that the best buyer is ready to pay that higher price. And if that gap is sustaining, logically it means that there are many such buyers who are ready to buy at the higher price. Okay, we'll come to the sustenance part later, but the reason why this gap can happen is that there is an implication of an overnight news, and that implication is strong enough to motivate a large number of buyers to go and buy at a market price, at a price which is much higher than the previous day's market price. Point number two, this could also be the same for a bearish market. Say there is an implication on the economy which is very poor. Some GDP data or something, some sort of variable, economic variable comes out as news. And say, for example, Nifty gaps down the next day. Now over here, we get a strong idea that the market sentiment overall has become bearish. And the best seller is the person who is ready to sell at the lowest possible price. Amongst all the sellers, the best seller will be at the top of the list. If you look at the the bid ask spread, right? Or if you look at the order book basically. So there are a large number of sellers who are ready to pay or ready to sell at a much lower price than the previous day's market close. So an overnight news can have an implication. Now, depending on how strong the implication is, often you will see that market prices behave in that manner. If there is an implication which is very strong, then it would motivate a large number and groups of buyers or groups of large number of sellers to push the price in one direction because they are motivated by the strength of the implication. Okay, if the news does not have enough implication, often things can be otherwise. It is not necessary that the market has to price in every little news in a way which you or I would perceive. The market tends to price in very strongly the stronger news. Okay, the more strong implications. Point number two is price momentum. So it may not be due to overnight news. It may be so that there is an existing trend in the market. There is an existing trend in a particular stock. Maybe there is no news at all, and the price momentum is already on the charts. We can clearly see that, say, for example, the price of Tata Steel has broken out from a certain resistance point. Now, that breakup has happened in the previous day. Continuing the strength and the high momentum and the high participation, where buyers are coming in and ready to bid higher prices for the stock. The stock closes with complete green candles on a 15-minute and an hourly chart, for example. And then the next day morning, the price is shooting up. The price is ready to shoot up again. It opens itself with a gap. So this could be one reason. This could be one reason. If reason is the word I like to use over here for the lack of a better word, this could be one reason why, or one variable we can gauge that there is a strength to this gap or not. Okay, so we're going to come with examples on those kind of things. Point number three, there could be intermarket correlations. Now, what do I mean by intermarket correlations? I simply mean that there are two types of intermarket correlation. One, I'm not saying that there are not other types, there are many other types, but two for example I will take. One would be the international markets, the global markets. So after 3:30, when the Indian markets have closed, the US markets, the European markets have not closed as yet. The next day morning, the Asian markets opened, many Asian markets opened before India's market. The Australian market also opens, in the morning. So all of these different markets, Japan, China, everything has different timings. Suppose there is something that that impacts the economies of all the countries. Say, for example, maybe the WHO declared the coronavirus as a pandemic. When they declared this, that okay, WHO recognizes this as a pandemic, the news came in towards the evening, if I'm not wrong. Okay, if that came towards the evening, Indian markets were not on at that time. US markets were definitely on at that time, because I remember there were some cues over there I could see on the television at that time. So European markets and the US markets, etc., closed relatively strongly lower. The Indian markets gap down. So there is a strong implication globally on all markets or for the entire world. So something like this could be an intermarket correlation. There could be other things. For example, a lot of companies have their stakes, a part of their profits would depend on the fluctuation of the dollar rupee currency. right? So any fluctuation in the dollar rupee may impact. So if there's a major fluctuation in dollar, there may be some impact over there. If there's a major fluctuation in rupee per se, there would be some impact over there. There could be certain intermarket correlation related to commodity prices. Maybe some base metal prices are related, or the oil prices are related, and there is something overnight happening on that front. Okay, so many times these intermarket correlations do play a role. I'm not saying that in order to trade you need to use fundamental analysis, but I do say that if the implications are strong, at times those news act as catalysts. Our judgment of the news or the judgment of its strength, of its implication, should be very clear if you want to trade on that basis. But we trade, or I trade, and my students trade on the basis of technical analysis. This can be like an added variable or an added information. Now, coming to the fact that these reasons could be the reasons why gaps are formed, let's see what are the different types of gaps that are there. Okay. Now, there has been a lot of ambiguity amongst various technical analysts, authors, researchers on the fact that is this a gap which could be called a breakout gap, or if this is a runaway gap, etc. There has been a certain, disclarity in the examples people have given also. So what I'm going to attempt today is I'm trying to go and bring in the essence of the gaps rather than going and naming everything. Okay, is this a common gap? Is this a breakaway gap? Is this a runaway gap? Is this an exhaustion gap? Rather than trying to name everything, let's understand the majority essence of a strong gap or exhaustion gap, or what a common gap means. Okay, because unless you don't understand the essence, the definition can be debatable. And I have seen this across many different textbooks. That these kind of definitions can have their own subjectivity. Okay, so this is an important point to note. Right now, let's understand this. What are the two major types of gaps? The two major types of gaps are the breakout or breakaway gaps and exhaustion gaps. Why am I calling these two major types? Because whatever trading perspective I'm going to share with you as to how you can really use these gaps to trade properly or understand the properties of these gaps, you need to categorize these, and you need to understand these two categories are very important. Number one is a breakout gap. Okay. Now, as you can see on the screen, often you will see that there are higher volumes when there's a breakout gap. Often it is aligned with a breakout which is happening with the gap itself, or a breakout which has just happened the last hour of the previous day or the last few hours of the previous day. Now, when there's a pattern breakout, I'll take an example and show you. Okay, it could be aligned with a support resistance breakout or a trend line breakout as well. Okay, so this is a type of gap which is called breakout gaps. Okay, now if I come to an example and answer the questions regarding, sir, do gaps fill? A lot of people ask me this question. Okay, let me become very clear over here. Okay, now you look at my screen carefully. There is an example right in front of you of a bullish breakout which is happening on a stock. Okay, this stock is having a resistance point on this particular blue line. Okay, the moment there is a breakout along with the gap, we call it a breakout gap. Okay, this is actually covering a lot of essence of the breakout gap itself. Now, whatever my pattern target will be, one, looking at the strength of the gap, I can easily go ahead and buy into this gap because there is a structure below this gap which supports the bullishness. Okay, so basically, if I were to zoom into this, okay, and show you, then I would say, let us imagine, ladies and gentlemen, that there is a particular move that has happened in the market and it has happened overnight. Okay, so if this was a strong green candle over here, and looking at the entire structure of the particular price pattern, I would buy into this strong green candle. So why would I not buy into this gap? Okay, so a lot of structural support is where breakout gaps happen, where there are strong breakout gaps. They could be just bought into. Okay, now I'm just saying that this is one variable. there are other technical analysis variables which you need to learn about. You can look at the description right under this video to connect us. If you want any help, connect with me if you want any help regarding the understanding of those variables. Okay. Now the second thing is that wherever you see that there is a zone of the gap, in case of strong gaps, be it a breakout gap or not, in case of strong gap, the zone of the gap, as in the previous day's close or the previous day's high and the next day's low or open, you will see this zone becomes a very strong support area in case of a bullish breakout. Okay. Later, when we see that the prices throw back on this area, they tend to form a base and go up steadily. Now, this is a property of a gap. If you understand that this entire area becomes like a very strong cushion, you will be able to understand the implication of the support zone. Okay. So this is one example. In some cases, so we saw that the breakout leads to an immediate move, and then later it can come back and retest that area also. In the essence of a lot of authors' observations, and my observation too, that it is not necessary that this throwback should happen or should happen in the near future. Okay, it can happen. Okay, now let's look at another gap, which is a bearish gap. Okay, a bearish gap down in the prices. There's a trend line on Nifty. This is 2020, the major fall which happened in the market, and in here we see that this trend line is being broken out overnight. Now you can see that these are daily candles, and over here you see that there's a green colored candle. Even though it's a gap down, it's a green colored candle. So what is happening is that on the daily chart there's a breakout, but because this is a green candle, it is telling me that the price has opened, gone down and closed at a higher level. That means this throwback which we are looking at is happening overnight. It's happening on intraday. This is happening on intraday itself. So the breakout has happened, a small throwback has happened within intraday, and price continues to move further down. Okay. Again, over here, I would like to reiterate that the entire zone of the gap, anywhere the zone of the gap can act like a cushion. Okay. Can act like a cushion. Now you will say, sir, how come anywhere in the zone of the gap? So what will be my stop loss? How will I trade it, etc. Now listen. Over here, we can clearly see that this trend line is not only just being broken out from as a gap down, there is a throwback exactly on this trend line. Okay. In case of bearish markets, volatility can be very high. Instead of maybe short selling, you could use by buying puts. Okay. Use this opportunity by buying puts, right? So this is an implication of the same, right? Breakout gaps can be very interesting to trade. So what is happening? Let's have a quick revision in case of breakout gap. We are seeing that something happened in the market which created a strong structure. If the gap up has happened in the markets, I can imagine it as an invisible move which happened overnight. Okay, and if I were to buy it in, if I were to see it in a normal trading day, I would probably bought it anyway when the breakout happened. So the gap is more reliable over here. That means this gap has a tendency to stand strongly. Often this is seen probably with very strong news implications being a catalyst. This only means that the buyers are ready to absorb all the sellers at higher levels and continue going up. Many times you will see that these gaps make a small flag and pole pattern. Okay, so basically if I was to make that invisible line, it would look like a flag, and after some consolidation in the morning, the prices would steadily rise up in case of a breakout upward gap. So this is telling me that the buyers are ready to absorb any profit booking or any selling by the sellers. Buyers are more convinced than the sellers, and that is a strong sign. That is why it is called a breakout gap, and breakout gaps are certainly very, very strong. Okay. Now, I'll go back to the slide where I discussed the two types of gaps are there from a trading perspective, a breakout gap and an exhaustion gap. Now, there are other two types of gap also. They're called runaway gaps or continuation gaps, and there are common gaps. Now these common gaps, for example, this word common gaps could be a more universal term, in essence, where on day-to-day basis, the prices of different stocks don't open at the same level as the previous day. They may be small, insignificant gaps, which are known as common gaps. Or if the price has a gap, but it doesn't have a structure, so there is no defined breakout happening, but there is a gap and it is significant and it is strong, it can hold the power of the breakout gap, even though there is no breakout visible. So depending on how the markets behave, depending on what the structure is being formed on the market, on the charts, we can say this gap is of some use to us or not. Let's go take an example from the chart of Nifty. Okay, now for example, I would say this gap does not show me any sense of a breakout, but this gap seems to have a lot of power. Why? Because even though this is a common gap, it will give me all the essence of a breakout gap, because the power of the move is so strong. Okay, all the essence of a breakout gap, and we see that there is a continuation in the price movement after some absorption of profits of profit booking. Right now, if I go to another, give you another example of a similar time when this happened. Okay, and this is taking a very decent example from a very past chart, so there are no biases that I've seen this recently, etc., etc. Okay, now let's look at this. Okay. Nifty has moved up and there is a corrective move later on the chart, and suddenly there is a gap up from this area. Now, is there any kind of pattern in place? Some may try to draw a trend line, but there is no trend line. Just joining 2 points doesn't make a trend line. Okay, the rules you need to follow. There is nothing in place which I can say that there was a breakout gap. Yet that's a big gap. I can still call it a common gap, but it gives me all the essence of a powerful breakout gap. Okay, this is what I'm coming to, that looking at gaps from either a breakout perspective or an exhaustion perspective is very important to develop a trading strategy around it. Okay, so I have given you some examples of breakout gaps which come out from patterns. I have given you examples of breakout gaps which look like common gaps, but they are very powerful, therefore they hold the essence of breakout gaps. We're going to take some more examples, and when we study exhaustion gaps. So let's go back to our slide and see what exhaustion gaps mean. Okay, now exhaustion gaps, again, it's a subjective definition. Overall, the meaning of exhaustion gaps is simple, that we have got a certain gap in the market prices. In some cases there could be big gaps, but the moment that gap happens, it tends to fill, or the gap is happening on low volumes. It is a part of the last fifth wave, which is an exhaustive move, and very soon in the same day or in the next few hours or next few days, the gap is ready to fill. This is also seen where the market prices, when the gap is happening many times against the larger trend, or the price is very overbought or oversold. Okay, so exhaustion gaps you will see when the market is overbought or oversold. There's a very extreme, and the last wave is taking place, covering the ending the impulse altogether. Okay, so that is a good example of an exhaustion gap. Now let's have a look at some examples of what I mean by exhaustion gap. Okay, often you will see that when the markets are overextended, these kind of gaps which are made, they do not have either the structure or the strength. So when technical parameters are ready to show that yes, the gap is started to fill in, that exhaustion gap, correct, in this case a correction is happening, not as just the exhaustion gap filling, the price is going much lower down. Okay, I'll take another example from Nifty itself, keeping myself to one chart so I can share the perspective clearly on different market phases, how these things happen. Okay, like for example, over here we see an extremely extended market with extended waves. There is no fresh pattern, no fresh resistance breakout. It is becoming a chart with a strong uptrend, but eventually there is an obnoxiously big gap. We see that it is immediately filling up with high levels of bearishness. Now this is an exhaustion gap. Now you will ask me, so how do I know from before? Or you will ask me, how do I trade it? This is subject to other technical principles depending on certain situations, depending on bullishness or bearishness, depending on what you're looking at. Say, for example, in this case, I would say, and as I share these kind of variables with my students, one of the things which would be very important in such a situation would be market breadth. Okay. Here, a lot of stocks were participating while the fall happened, and very quickly the previous day's range got broken. Okay, so these are strong cues for bearishness. The candles itself are strong cues for bearishness. There was a lot of there was a lot of clarity with this being a resistance zone by itself. Okay, so there could be a number of variables that could help us understand what category of the gap is this which I'm talking about, right? So this is something which is supposed to be understood very, very well. We'll also take some example from say Bank Nifty in a moment. Okay. Now coming back to the chart of Nifty, in the recent past, there's some exhaustion gaps which are of a slightly different criteria. Okay. So for example, let's look at these circles which you can see over here. Now this is also an exhaustion gap. Okay, not as big as the one you saw, but following the similar essence, that there is a gap which is coming at the end of a small impulse, and the overall trend has been completely turned around from. And in this case, the overall trend is down, as you can see, and there is a gap up, a surprising gap up, which has nothing to get support, and then the entire gap covers up. There is a fall in the market. Okay. So this is another example of exhaustion gaps, and it's better understood by looking at n number of examples. You can also find out examples on your own, and it will help you. So there are a number of ways in which gaps tend to behave. Let's take a few examples on the hourly chart of a Bank Nifty. Okay. So what I'm going to do is I'm going to go back again and show you places where I chalked out that there are some gaps worth looking at, right? Now over here, as you can see, there are a couple of gaps we can see. Okay, you can see that there are some big gaps. Okay, only the big gaps are important, that will reflect on the daily chart. If I put this the daily chart, only the bigger gaps will be shown, right? So I'll just show you the areas which I want to point at. Number one is this. You see, this is a breakout gap. Now what happens here, sir? The breakout gap is happening, but there is a throwback within the same day and then the continuing downtrend. Okay. The other nature of a breakout gap over here is that there is no throwback. This is a strong breakout gap from this resistance and a cup and handle pattern on Bank Nifty. So this could be categorized by a strong green candle, which is a breakout candle, and the price is trending in the next few days. Okay, so these are examples of breakout gaps and exhaustion gaps. I hope you understood and took away something from the basic understanding of gaps. Now runaway gaps are defined as gaps which are running in an existing trend. Often the common gaps are defined by small insignificant gaps or by significant gaps, but which cannot be categorized as exhaustion or breakout, at least when they're being made. Okay, for someone who did not understand things from this video, you could look at other simpler videos in my channel. This is specific to one topic, and therefore maybe for the newcomers or the newbies, if they have any confusion, then I'm going to suggest them to look at those overall videos on technical analysis which I have made, or trading psychology which I have made. Okay, now the last part of this particular video: do gaps always fill? There is no compulsion for the gap to be filled. Let me tell you this. Now statistically, if I put all the numbers together, and this is not something, again, this is tested on certain markets, this is not tested in every market. So for one market, there was a study made, and more than 70% of the gaps for a certain period of time were seen to be filling in the next few days itself. Now, what does this mean? It means that maybe, yes, gaps have a tendency to get filled, but it also means that those 30%, or in different markets that percentage could be different, they don't tend to fill. Okay, they don't tend to fill for long number of days, years, and some have not filled for a very long time. Okay, so taking the example from Nifty, there are this Nifty chart has got n number of gaps which have happened, and the bull run is still on. So this gap which I see over here of a new price territory exactly coming from this breakout, okay, I don't see that this gap has been filled. The market has not come back as yet, and it's been months and months, and there have been other gaps along the way which have not been filled. Okay, so this one, for example, got filled much later. So there is no such rule that the gap should be filled in the next few days or the next few weeks or the next few years. What is important is to understand the nature and how to trade in the now moment, regardless of these sort of principles which you make up in your mind, this gap will be filled or not. Okay, because this can tend to make you biased. Okay, breakout gaps are that happen at an important juncture, like the one which I showed you at the lower level, and then they seem like a common gap, but actually it was very powerful. So it could be categorized as a breakout gap. Now that was at such an important juncture that it had a very strong essence. It had a lot of strength, and it did not get filled very easily. Okay, so filling gaps or not filling gaps is not a reason to trade. It is not a reason to make a market view in the short term or medium term. But what is important is to understand if the gap I'm seeing right now has a strength, has a certain thing, a certain price structure around it that supports its strength, or if it is weak and needs to be taken from the opposite directional perspective. If you enjoyed learning from this video, do subscribe to my channel, and if you want to learn more, you can always connect with us. The links and everything is given in the description box. The phone number is also given in the description box. You can go to www.technicallysorted.com to know more. Thank you so much for being with me today. Have a great time learning and happy trading. Take care, goodbye, and enjoy.